Here is a number that should genuinely disturb you. In the first 3 months of 2026 alone, 37,121 Canadians filed for personal insolvency, and according to the Canadian Association of Insolvency and Restructuring Professionals, that is the highest quarterly volume this country has seen since the global financial crisis of 2009. Not since the world was melting down, not since banks were collapsing on international television, has Canada seen this many people formally declare to the government that they simply cannot pay their debts. And the thing that makes this moment so much darker than 2009 is that there was no single catastrophic event that caused it. No mortgage-backed securities implosion, no Lehman Brothers moment. This happened in ordinary times, during ordinary Tuesdays, in ordinary Canadian households where people were just trying to buy groceries and keep the lights on. Let that translate into a human scale for a moment. The CAIRP report put it this way, that those 37,121 filings work out to roughly 17 Canadians filing for insolvency every single hour of every single day for 3 straight months. While you were commuting to work, while you were cooking dinner, while you were watching something on Netflix, 17 of your fellow citizens were sitting across a desk from a licensed insolvency trustee and signing documents that said they had reached the end of the road financially. This is not a fringe story about people who made reckless decisions. This is a systemic failure, and the villain at the center of it is not some foreign bank or shadowy hedge fund. The villain is a debt machine that Canadian lenders, credit card companies, and a federal government that never built a serious safety net for household finances have been running for years, and it is now collecting. The mechanism is straightforward and brutal. Canada's total non-mortgage consumer debt closed out the full year of 2025 at $698 billion, which according to Equifax Canada's full-year Global Credit Trends report represents a 4.5% year-over-year increase driven primarily by credit card balances and auto loans. The average non-mortgage debt per Canadian consumer now sits at $22,377, up 2% from the previous year. And according to Statistics Canada's national balance sheet data for the fourth quarter of 2025, total household credit market debt across the country has reached $3.2 trillion, meaning Canadian households collectively owe $1.77 for every single dollar of disposable income they earn. That debt-to-income ratio of 177.2% puts Canada among the most indebted household economies in the entire developed world. But the credit card debt is the piece of this that keeps insolvency trustees awake at night, because credit card debt is not like a mortgage or a car loan where the interest rate is locked in at something manageable. Credit card debt in Canada sits at a standard rate of approximately 19.99 to 21% annually, and according to Equifax Canada's Q1 2025 Consumer Credit Trends report, the average Canadian credit card balance hit $4,185 in early 2025, an all-time high, and by the third quarter of 2025, that number had climbed further to $4,652 per cardholder according to a December 2025 Global News report citing fresh Equifax data. TransUnion's Q1 2025 Consumer Credit Report put the average balance at $4,415 and noted a 3% jump year-over-year. These are averages. For the millions of Canadians carrying $10,000 or $15,000 on their cards, the math is catastrophically worse, and we are going to show you exactly what that math looks like in a few minutes.
Let's start with the insolvency numbers because they are the clearest signal that something has gone badly wrong and that it has been building for years. According to the Office of the Superintendent of Bankruptcy Canada, Canadians filed 140,457 consumer insolvencies in the full calendar year of 2025, which the CAIRP confirmed in their February 2026 release makes 2025 the highest annual insolvency total recorded since 2009, and the second highest in Canadian history. That figure represents a 2.3% increase from 2024, and it pushed insolvencies above the previous peak recorded in 2019 before the pandemic temporarily suppressed filings due to government emergency programs and mortgage deferrals. That suppression, those years of pandemic relief money masking the underlying rot, is a big part of why the situation in 2026 feels so sudden to so many people even though the professionals saw it coming.
The CAIRP's Q1 2026 release then showed that this trend is accelerating hard, with the 37,121 filings in just the first 3 months of 2026 representing an 8.5% increase over the same quarter in 2025, and a 6.5% jump from the prior quarter alone. British Columbia saw the biggest provincial surge at 16.2% year-over-year, and Ontario, the economic engine of the country, saw insolvencies climb 14.7% to 13,913 filings in just 3 months. Licensed insolvency trustee and CAIRP Vice Chair Wesley Cohen said in the Q1 2026 report that the data suggests more Canadians are reaching a financial breaking point, and that the concern is that many households are entering this period of economic uncertainty already carrying debt they can no longer comfortably manage. That is the language of professionals trying to be measured and careful. What they are describing is a slow-motion collapse that is picking up speed. And the picture gets even darker when you look at who is filing and what they owe. Hoyes, Mikolos and Associates, one of Canada's largest and most respected insolvency firms, released their annual Joe Debtor study in February 2026, and the numbers in that study are staggering. The average insolvent debtor in Canada owed $67,496 in unsecured debt in 2025, according to that study, and that is the highest level recorded since the firm began tracking this data back in 2011. It represents an 11.2% increase in just 1 year, and a nearly 37% increase over the past 3 years. Doug Hoyes, licensed insolvency trustee and co-founder of the firm, put it plainly in the press release, saying that this is not about one bad financial decision or a sudden crisis, that Canadians are layering borrowing on top of borrowing, leading to insolvencies with unprecedented debt levels. His partner Ted Mikolos went further, saying that Canadians are using credit as a coping strategy, and that layering credit can buy time but it does not fix the problem, and that once borrowing capacity runs out, insolvency filings tend to rise quickly. These are not alarmists or people with something to sell. These are federally regulated professionals who have been watching this system from the inside for decades. Now let's talk about the math, because the math is where the trap becomes visible, and once you see it you cannot unsee it. A Canadian carrying $10,000 in credit card debt at the standard rate of 19.99% annually faces an interest charge of approximately $1,999 in the first year alone, which works out to roughly $166 of interest every single month before they pay down a single dollar of the original balance. If that person makes only the minimum payment, which for most Canadian cards is calculated as the greater of $10 or 2 to 3% of the outstanding balance, their minimum payment in month 1 is approximately $200 to $300, meaning that after making that payment, only about $40 to $130 actually reduced their debt, while the rest went straight to the lender as interest income. At that pace, basic amortization math shows it would take well over 25 years to pay off that $10,000 balance if only minimums are made, and the total interest paid over that period would exceed the original debt by thousands of dollars. You borrow $10,000 and you end up paying back $25,000 or more.
Now scale that to $15,000, which is closer to what many struggling Canadians are actually carrying. At 19.99%, the first year of interest alone is roughly $3,000, which is $250 a month that does not buy food, does not pay rent, does not put anything toward the actual debt. The minimum payment on $15,000 might sit around $375 to $450 per month, meaning half of every payment or more is being eaten by interest. To pay off $15,000 in 5 years at that interest rate, you would need to pay approximately $320 per month, and the total interest cost over those 5 years would still add up to around $4,200. Most people making minimum payments will never get there. The balance grows, the minimum payment adjusts upward, and the trap tightens.
According to a May 2025 Equifax Canada report cited widely in Canadian financial media, more than 1.4 million Canadians missed at least one credit payment during the first few months of 2025, and delinquency rates among young consumers under 36 jumped by 21.7% year-over-year. Equifax Canada Vice President Rebecca Oakes noted that defaults were rising especially in younger households and homeowners in urban centres. And according to Equifax's full-year 2025 Global Credit Trends report, total consumer debt in Canada crossed $2.66 trillion by Q1 2026, up 3.8% year-over-year. These are not rounding errors. These are generational numbers. But if the credit card spiral is the mechanism, the fuel that feeds it is a phenomenon that most middle-class Canadians would never admit to publicly but that the data shows is spreading rapidly. The payday loan industry. According to the Financial Consumer Agency of Canada's published research, approximately 1.9 million Canadians access payday loans annually, and according to Finder Canada's 2025 analysis, payday loans in Canada cost $14 for every $100 borrowed as of January 2025 following a regulatory fee reduction, which still translates to annual percentage rates reaching into the triple digits, with some lenders charging effective rates exceeding 300 to 400%. April. The regulatory cap on fees has come down, but the structural trap remains the same. You borrow $500 because your credit card is maxed out and the rent is due, and 2 weeks later you owe $570, and if you cannot cover that, you roll it over and the number grows again. The FCAC's own research shows that in Q1 of 2023, 13% of payday loan users took the loan specifically to buy groceries, 11% used it to pay an electricity bill, and 8% used it to cover gas, meaning this is not a product being used by people making irrational luxury purchases. This is survival borrowing, and the people doing it are not just the traditionally vulnerable. As the MNP Consumer Debt Index from January 2026 showed, 41% of all Canadians are currently within $200 of being unable to meet their monthly financial obligations, and 71% expect their cost of living to worsen further in 2026. When you are that close to the edge, a single unexpected expense, a car repair, a medical bill, a missed shift, does not send you to a savings account you do not have. It sends you to a payday lender. Scott Theriault, manager of consumer insolvency at Hoyes Michelos & Associates, told Canadian Mortgage Trends in March 2026 that the biggest new development in insolvency filings right now is homeowners, with the firm's homeowner bankruptcy index climbing to about 7% in early 2026 after hovering near 1 to 2% during the housing boom years. He said, and this is a direct quote, that we have had generational inflation, and that if your grocery bill used to be $700 a month and now it is $1,200, you have a problem. And that problem does not go away when interest rates move by a quarter point in either direction. It compounds, every single month, on top of everything else.
The mortgage renewal wave layered on top of this consumer debt emergency is what makes 2026 genuinely unprecedented. According to Bank of Canada data cited in multiple analyses, 60% of outstanding Canadian mortgages are renewing during 2025 and 2026, representing roughly $600 billion in mortgage value. Homeowners who locked in at pandemic-era rates of 2.0 to 2.5% on 5-year fixed terms are now renewing into a market where rates sit between 4.5 and 5%, producing monthly payment increases of $300 to $700 depending on the mortgage size. According to Collector HQ's April 2026 debt stress analysis citing Bank of Canada data, a $500,000 mortgage at 2.5% had a monthly payment of approximately $2,650, and that same balance renewing at 4.5% produces a payment of $3,150, a $500 per month permanent increase.
That last point is the one that deserves its own full chapter. The Financial Accountability Office of Ontario projected in its 2025 analysis that U.S. tariffs would eliminate 119,200 Ontario manufacturing jobs from the baseline scenario, concentrated in the sector hardest hit, with 57,700 manufacturing positions gone, meaning steel workers in Hamilton, auto parts workers in Windsor and Oshawa, machinery and electronics workers across southwestern Ontario. Statistics Canada's Labour Force Survey for February 2026 showed Canada lost 84,000 jobs in a single month, the worst monthly jobs number since the pandemic, pushing the national unemployment rate to 6.7%, the second highest in the G7, with youth unemployment for workers aged 15 to 24 surging past 14% after 47,000 young workers lost jobs in February alone. These are the people now cycling debt onto credit cards. These are the people now calling insolvency trustees for the first time in their lives. So where does this go from here? Based on everything in the data, there are 3 realistic trajectories, and you need to understand all 3. The best case scenario looks like this. The Bank of Canada continues gradual rate reductions through the second half of 2026 and into 2027, bringing the prime rate down enough that mortgage renewal shocks moderate slightly and credit card minimum payments become somewhat more manageable for borrowers near the edge. Trade disputes with the United States resolve or at least stabilize, preventing further large-scale manufacturing layoffs in Ontario, and the federal government introduces some form of meaningful household debt relief program, potentially including expanded consumer proposal awareness, tighter credit card interest rate regulation similar to what some provinces have discussed, and more aggressive payday lending reform. In this scenario, annual insolvency filings in 2026 and 2027 stabilize somewhere in the 145,000 to 155,000 range, painful but not catastrophic, and the system absorbs the shock without a structural crisis in the banking sector. The honest assessment of this scenario is that it requires everything to go right simultaneously: the rates, the trade policy, the political will for consumer protection reform, and based on the track record of Canadian governments on household debt, there is very little reason to believe all 3 conditions will be met at once. The realistic case scenario is what the data actually points toward. Annual consumer insolvency filings in Canada break through the 2009 record of 151,712 sometime in late 2026 or early 2027 as the mortgage renewal wave, the manufacturing job losses, the federal workforce reductions, and the compounding credit card debt all peak simultaneously in the second and third quarters of 2026. Collector HQ's April 2026 analysis cited projections from licensed insolvency trustees of 20 to 30% spikes in Q2 and Q3 2026 quarterly filing volumes, potentially pushing toward 185,000 to 190,000 total annual filings, which would be territory Canada has simply never seen outside of a full economic depression. Home prices in manufacturing-dependent communities like Windsor and Hamilton soften further as laid-off workers list properties they can no longer afford. The Hoyes-Michelo's Homeowner Insolvency Index, already at 7% in early 2026 after years near 1 to 2%, continues climbing.
This does not end in a dramatic crash. It ends in a prolonged, grinding squeeze on the households least able to absorb it, while institutional lenders, who have already tightened credit originations as TransUnion reported in early 2025 with bank card originations dropping 3.7% year-over-year, quietly protect their own balance sheets while leaving individual Canadians to manage the consequences. The worst-case scenario requires a specific combination of bad luck on top of the structural problems. If the U.S. tariff situation escalates rather than stabilizes, if the Bank of Canada is forced to hold or raise rates again due to renewed inflationary pressure from trade disruptions and currency weakness, and if the federal job cuts accelerate faster than currently projected, then you have a true compound crisis hitting the 41% of Canadians within $200 of insolvency from 3 directions at once.
In that environment, the 185,000 to 190,000 insolvency filing projections for 2026 are a floor, not a ceiling, and you begin to see secondary effects: rising default rates on secured debt like auto loans and lines of credit, banks tightening credit access for exactly the households who need it most, and food bank usage, which was already at an all-time record of 2 million visits in a single month in March 2025 according to Food Banks Canada, continuing to climb as the financial floor drops out from under another layer of households who thought they were middle class until they were not. If you are a renter in a major Canadian city right now, the insolvency wave is actually creating a specific pressure on your situation that most people have not connected yet. As homeowners hit by renewal shock and job losses begin listing properties, there will be a short window in some markets where housing inventory briefly increases and softens prices slightly, but the structural supply shortage in Canada's major cities means this will not last, and the combination of job losses and tighter lending standards means fewer people will qualify for mortgages anyway. Your rents will likely stay elevated or increase further because the fundamental shortage of supply is not going to be resolved by insolvency filings. If you are a renter carrying significant credit card debt right now, the single most useful thing you can do is get a free consultation with a licensed insolvency trustee before your situation gets worse. CAIRP's website has a directory of federally regulated trustees who will assess your situation at no charge, and understanding your options before you are in crisis is dramatically different from understanding them after. If you are a homeowner facing mortgage renewal in 2026, the math that Hoyes Mikolos and Collector HQ both lay out in their analyses suggests that combining amortization extension at renewal with a consumer proposal for unsecured debt can, in specific circumstances, produce monthly cash flow relief of $900 to $1,200, because extending your amortization from 20 to 25 years saves roughly $300 to $400 per month on a $500,000 mortgage, while a consumer proposal that settles $40,000 in unsecured debt for $12,000 reduces monthly minimum payments by $600 to $800. This is not a strategy for everyone, and it comes with real credit consequences, but it is an option that thousands of Canadians are using right now, and it is worth understanding before you simply absorb a $500 monthly payment increase on top of an already stretched budget. If you are a worker in Ontario's manufacturing sector in cities like Windsor, Hamilton, London, Oshawa, or Kitchener-Waterloo, the financial data says you are in the highest risk category in the country right now. Windsor's unemployment rate already sat at 11.2% in Q2 2025, the highest in Ontario, and the tariff-related job loss projections from the Financial Accountability Office have the manufacturing sector in those regions facing the peak of layoff activity between now and the end of 2026.
If you receive a layoff notice, the single most time-sensitive financial decision you face is that consumer proposals filed within 7 to 14 days of receiving that notice can protect your severance pay as an exempt asset under the Bankruptcy and Insolvency Act, meaning it is preserved to fund your living expenses during job search rather than burned on credit card minimums for creditors who would receive only 20 to 40 cents on the dollar through a proposal anyway. Waiting until the severance runs out is the most common and most expensive mistake people in your situation make.
If you are a young Canadian under 35, the data from Equifax Q1 2025 report showing a 21.7% year-over-year spike in delinquency rates for your age group should register as a serious warning about a structural problem, not just individual behavior. You entered the workforce or attempted to enter homeownership during the most extreme cost of living environment Canada has seen in decades, with student debt, rent, groceries, and transportation all at generational highs while wages lagged behind. The NerdWallet 2025 Canadian Consumer Credit Card Report found that 74% of Canadians used credit cards for essential purchases in the past year, up from 69% the year before, and among the people changing their credit habits, 60% said the reason was that prices for goods and services were higher. This is not a spending discipline problem. This is a structural income and affordability problem that expresses itself as credit card debt because credit cards are the only flexible shock absorber available to most households. Thank you for watching this full breakdown, and remember that every single statistic and report mentioned in this video is linked down in the description below so you can verify the numbers yourself. If you are dealing with this in your own life, or if you completely disagree with my analysis, please let me know in the comments because I read them all. Make sure to subscribe for more deep dives into the economy and real estate market, and I will see you in the next one.